Welcome to the InterMarket Analysis video update. This is a weekly video where I not only look at other markets to see if they're giving us some clues as to what's happening in the S&P 500, we also look inside the S&P 500 at valuation, as well as looking forward at valuation and historically at valuation. Then I do a pretty in-depth section on growth versus value. Typically, when growth is outperforming, that really gives the market more support because you want to buy low and sell high. When the value is outperforming growth, that's when we see the market becoming more defensive, typically. This is being prepared for Monday, August 12th. I do have a thing called the SPXInvesting Program. If you want to learn more about that, there are links in the description below this video. There's also links to tell you more about the program itself. You can email me if you would like. It's free for right now. I will be locking that down in August at some point. I have some logistics to work out there, but feel free to check that out and see if it's something that is of interest to you. I post a lot of additional things that I don't post on YouTube or Rumble. Also, this video, the InterMarket Analysis video, is just one of the weekly videos that I do, and all of the videos tie into the daily video. So if you really want to get a handle on what's happening within the S&P 500, look at the daily videos. I know they're longer than other videos out there. I know people are often looking for quick answers, but especially right now where things are getting a little bit complicated, in the daily videos, we were able to see things actually develop at the end of last week and then take advantage of that while everyone was reacting to the big down day on Monday. We were booking profits at that point. And so this gives us a little heads up as to what's happening as we see things developing day by day. All right, so the first area we look at is the valuation of the S&P 500. First, we look historically back at earnings that have already been released. And we have a scale between 10, 15, and 20. When we get above 20, the market is considered to be expensive. When it's 10 or under, the market is inexpensive or cheap. When we're about at 15, we're considered to be fairly priced. Then we plot that here with the S&P 500, and we can see that the black line, the S&P, is well above this red dashed line, which means we have a PE ratio well above 20 right now. So on a historical basis, we are considered to be expensive. But if you look all the way back to 1980, we can be above this red line for years at a time. So it's not necessarily anything that we use for timing or to make decisions. It just gives us an overall idea on a historical basis. What is the market valued at this time? This also plots some different events that have happened and what the valuations were at that time. Then there's a variation of looking backwards that was developed by Robert Shiller called the Shiller PE ratio. It takes a smoothed approach over about a 10-year period. You may also hear this referred to as CAPE, C-A-P-E, or PE10, because he uses 10 years of earnings to smooth things out. And right now we're coming in with a score of 34.47. Excuse me. To give that some context, here is a historical chart to show what the valuations were at that time, going all the way back into the 1800s. Well, another helpful thing can be the median and the mean, where we're between about 16 and 17. And we've been at this place for quite a while now. And with the current reading of 34.47, we're pretty much double expensive on a historical basis when you look at this chart just by itself. Then the market looks forward with the PE ratio. And in addition to the S&P, the mid caps, and the small caps, which you see here in red, blue, and green, we also have the mega cap 8 or the magnificent 8 or the great 8 or whatever you want to call them, magnificent 7, whatever they are. And with the drop off, and we've been seeing money coming out of the mega caps lately, and so the PE ratio has been coming down, but it's still very high at 27.6. But folks are okay with that. They're okay buying an expensive stock with the idea that it's going to go even higher in price and they'll be able to sell it somewhere into the future. With the S&P, when we get above 20 looking forward, that's a little bit more of a concern. That means even on a forward-looking basis, which is more optimistic, we're looking rather expensive, and we're coming in at 20.1. even with the love that we were seeing there for a while in the small caps, they're still coming in under 15 at 14 and a half. And the mid caps are coming in right at 15. So both the mid caps and small caps on a valuation basis are considered to be fairly valued. But at the same time, what does earnings growth look like? What do interest rates look like? And that's why a lot of the small caps, and even to a degree the mid caps, have really been holding back lately because they have to borrow a lot of money. And when interest rates are higher, they have to pay more, and that eats into their earnings. So the hope was with interest rates going down, that would be more beneficial for small caps, especially. And we saw them really start to take off. Well, then we saw some economic reports coming out that were a little too weak, especially the employment situation report a week ago. And instead of saying, okay, interest rates are coming down, well, now we have to look at the context as to why are interest rates coming down. Is it because the Fed wants to stimulate the economy after coming back down to their close to their inflation target? Or is it because the economy is really starting to show some weakness? For a lot of 2024, it was, yeah, the economy's hanging in there, doing very well. An interest rate cut would actually be positive for stocks to help stimulate things. Well, then about a week ago, and it seems to be not as big of a deal right now, but this could always shift back. But then with the weak employment report that came out, it's like, uh-oh, the economy's not just slowing down. It could be actually declining to the point where we might go into a recession. So now we're going to take bad news as bad news, where we had been taking bad news as good news. And that really bites into this. And that's why we're seeing the pullback. And then that also fed over into Monday, where things started to fall apart with the carry trade in Japan. And I'll go through that when I get to that chart. Okay, looking at growth versus value, we have been seeing a pullback, actually declined below its 200-day moving average, but was able to recapture that throughout the week. And everything got hit, where we saw value coming down to its 200-day moving average. So this support level actually held up when we look at value all by itself. But to get some insight, we do a lot of ratios between the two, growth versus value and value versus growth. And sometimes I do inverse versions of these charts because they calculate a little bit differently. And sometimes we might see some things that we don't see otherwise, where growth had really been outperforming value. And it came all the way down to this 200-day moving average with this ratio. And then value had been underperforming and it came up almost to the 200-day moving average. And now it's starting to bounce back as things are calming down a little bit in the markets right now. Then we look at a longer term chart of growth versus value. This is showing where even with the pullback that we've seen, growth is still outperforming value. Here's an inverse showing how value has been underperforming growth, even though it did bounce back up as the market was getting more concerned about economic weakness. There's another look also showing how growth has been outperforming, even though it fell back. It came down to the 200-day moving average with this ratio and has been bouncing back up. There's another one more condensed as far as time, where we look at how value has been underperforming. It did start to bounce back up, but now it's been coming back down. And then here's another one, growth to value, showing how growth is outperforming value here. And we look at a couple of ETFs, and I've been really watching this one, and I go over this in the daily video. With this growth to value ETF ratio, we actually came down to the 250 period moving average, and we were watching that to see would we be able to bounce up off of this. Well, no, we actually dropped down below it, but we've been able to recapture that now and go back up into the rainbow as things are showing some improvement. Then here's an inverse of that same thing, where value was really starting to outperform, but now has been pulling back. Then we break this down more according to indexes. The small cap growth to value ratio is just not doing very well right now. In fact, we've seen a recent death cross here with this ratio. And mid cap growth to value, it bounced up a little bit late last week, but still it's not doing all that well and is in a downtrend. And even S&P growth to value, it's been bouncing back up. It's still in a longer term uptrend, but we want to see this really going up and really outperforming, and that's just not been what's happening. We also keep an eye on inflation. We have a CRB monthly chart here on the top, where we're seeing inflation coming down now below the moving average. And then we look at the bottom, we take a ratio between inflation and deflation. And when this is going down, that means inflation is going down. and we're below a declining moving average. And we want to keep an eye on this because if this really starts to go lower with some velocity, deflation is actually worse than inflation. I mean, you might think prices going down, that's great. I think that's all wonderful. Well, it actually does a lot more damage. Hence, we had the Great Depression in the 1930s. So this going down is not really a concern right now. It's just something we want to keep an eye on. It'd be nice if this just went flat, but that's not how markets move. Then we look at the CRB index with a daily chart, and they've been getting hammered a lot lately. They did bounce up a little bit later in the week. They went down with stocks as well. They're still in an uptrend, but we're starting to roll over with the 50-period moving average right now. We look at the Baltic Dry Index, which has been really chopping around lately. Typically, as a general rule, when this is going up, that's more inflationary because it costs more to ship products. When this is coming down, that tends to be more deflationary, and it's pretty much been going sideways for the time being. Then we look at some other markets. This is aluminum, which is still in an uptrend, but it really fell earlier in the week as well. Corn, which has been in a downtrend, so that's more deflationary. Wheat's also in a downtrend. And we look at fertilizer, which had been going up here as we were into July, but since then has been tapering off a bit. And oil, we want to watch this for a couple of different reasons. If it's really going up, that of course can be inflationary because it costs more to fill up your car or truck. But there's also geopolitical concerns behind this. And there's the potential escalation of things in the Middle East. And that's where a lot of oil comes from. So if we see a real spike up for geopolitical reasons, that could be negative for the market. If we see oil going up because they're making more money and the oil companies are more profitable and folks are really getting into those as investments, that's the positive side of things. So we want to make sure we maintain an eye on the context of why it's going up or down. It's pretty much been in the mid 70s right now. It hasn't really been impacted all that much by what might be developing in the Middle East between Iran and Israel. And then gas continues to be in a downtrend, which is probably a relief to a lot of folks. Now we are coming up to an election, and so there's going to be some manipulation, if you will, to try to keep gas prices lower, because this is something that everybody sees and everybody has to deal with. And politicians want to keep gas prices down when we get close to elections. We also keep an eye on diesel, which has been declining. This is mainly for 18-wheelers and railroads for transporting things. And if that goes up, that means their costs also go up, and that's more inflationary. Heating oil is continuing to go down right now. Natural gas is also in a decline. And we keep an eye on copper because it tends to reflect what it thinks the economy is going to do going into the future. When copper is really going up, that means that it's looking better economically. When copper is going down like it has been lately, we're not quite at a death cross here yet, but we're getting pretty close. And with this economic weakness, the fears that have been coming into the market, that's why we're seeing copper really going down. We also look at a ratio between copper to gold, and we're actually seeing a recent death cross here as copper has really been underperforming gold. And it's not that gold has been doing all that great. It's that copper has been doing pretty bad lately. And I'll show you that here in a moment too. Where the black line, this is longer term going back to 1980. When this is going down, that means copper is underperforming. To give it a little more context, we're also going down with the 2-year yield, which is in green, and we've been coming down with the 10-year yield, which is in red. And this suggests economic weakness. Now, if we start to go back up here and interest rates are stabilizing and actually getting more around the 4% with the 10-year yield, that means the market may be settling down. If we're really falling because they're afraid of economic weakness, these will continue to fall. This ratio will continue to fall as well, and that could be more dangerous for stocks. We look at gold, the ETF. I don't look at the futures contract. I mainly follow the ETF here, where it's still in an uptrend, but it's pretty much just been chopping sideways. Also, silver is actually down below its 50-day moving average, but still in a longer-term uptrend. We look at the closing price for gold on top and the closing price for silver on the bottom, and then we do a correlation between the two, and they have a fairly strong correlated relationship right now. There are times when silver outperforms gold and then this correlation goes down. There are times when gold outperforms silver and this ratio can also go down with the correlation here. But they're both holding up fairly well and going in the same general direction at the same time. And we look at the gold to silver ratio on top. When this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming. And then sometimes, not right now, but sometimes we can get some insight by plotting the US dollar index below. The dollar's been under some pressure lately as well. But if you look at the correlation between the two, they're having a tendency to actually go in opposite directions. Where this is most helpful is when we see a high correlation, meaning that the top part of the chart and the middle part are going in the same direction at the same time. And that can often help us to decide, okay, what are precious metals doing in relation to the US dollar index? Here is the dollar, which has been under some weakness, but it's getting ready on the weekly chart to show a death cross here pretty quick. But we're still in an uptrend here. We have the shorter term moving average still above the longer moving average, even though the dollar has been declining lately. And a declining dollar is typically more positive for stocks. And this is looking back over the last 3 years. We were almost coming back down to this trend line here, but we didn't quite hit that level. And we look at the euro, and since the euro is such a huge part of the US dollar index, these are almost a mirror image of each other. This is like the mountains, and this is the reflection on the lake. They really correlate in the opposite direction here. And here is the euro to the dollar, and it's not quite in an uptrend yet. It's still above both of the lines. It had been trailing off, which actually kicked us over into a downtrend. We're what is that, 1,000th of a percent or 1,000th of a point away from this actually crossing over and becoming an uptrend. So the euro is still in a downtrend compared to the dollar. And we keep an eye on the Japanese yen, and that was what was causing a lot of the problems earlier in the week. We plot the euro down here and then the dollar index down below. All right, so what was happening in Japan? That's known as a carry trade, and I've been explaining this in the other videos as well. To explain this in very simple terms, if you have $100 and you take it to the bank and you put it in your savings account, and they're giving you whatever interest rate it is, 0.5%, 0.1%, very low historically. Well, again, in a real simplified way, they then take that $100 that you put into the bank and they loan it to somebody else, but they may be charging 8 or 10 or 12% interest for somebody to borrow that money from the bank. And that's called a carry trade. And what was happening in Japan is the zero interest rates, which Japan had been having forever. Folks were basically able to borrow money at no cost and then put that money to work and be able to do a trade of the dollar versus the Japanese yen. Well, Japan, the Bank of Japan, decided to come in and raise rates. Well, when you raise rates in a country, that means the currency for that country becomes more precious because it costs more to borrow dollars or yen or euros. And so we saw the yen really starting to go up against the dollar. And notice this just didn't happen on Monday. This is when everyone was talking about it on Monday, but we saw this happening and things shifting a bit more negative. And that's why I really stress watching the daily videos. But even though it's still in a downtrend, the yen had really been going up against the dollar, and that was causing all kinds of problems with the carry trade and folks that were very highly leveraged because they were like, hey, I've been doing this for years and years, and there's no risk behind it. I'm just making money. Well, that all started to change. People were getting margin calls. There were all kinds of losses that folks were starting to accrue. And so they had to start unwinding these positions. That fed over into the Japanese stock market because the US dollar was also involved. It spread all throughout Asia. It went over into Europe, and then it finally came into the US in Monday's session, where not everything started and stopped on Monday. This had been building for a while. And then by the time a lot of folks reacted to it, it was too late. Like a lot of folks came in on Monday and we saw the highest put volume on the S&P that we've ever seen, only to have the S&P go up 2% the next day. So They not only lost money by reacting to what already happened, they lost more money the next day by losing on some options because instead of watching the charts, they're following the news and they tend to be late to the party when that happens. Okay, the British pound to the US dollar is still in an uptrend, even though it's coming back down to the 200-day moving average with this measurement, this ratio between the two currencies. All right, the indexes. When we see the red line above the S&P, the red line's the equal weight S&P. It treats all stocks the same, where the S&P itself is a weighted index, so the really big companies have more of an impact. When this is above the S&P itself, that just means the rest of the S&P is holding up a bit better. Now, they are on different scales, but when the red line is above the bar chart, that just is much more positive for the market. And it's been holding up a little bit better, even as we were declining. So that's more positive in the background. There's another way of looking at this. When this is going down, that means the equal weight is underperforming. This has been going back up, even though it fell down. Friday was a pretty good day for the mega caps, so that's why this ratio is coming down a bit. But for this to continue to decline, that means the mega caps are outperforming. When this is going up, that means the equal weight is outperforming. And we look at a ratio between stocks and commodities, and both got hit pretty hard, especially earlier in the week. We came back down to the 50-day moving average with this ratio, but this is still showing that stocks are outperforming. Here's an inverse showing how commodities are underperforming stocks. We look at the NASDAQ 100, which has been under pressure lately, but still doing well for the year, and the S&P 500, which is holding up a bit better now. That's why we're seeing this ratio going down. The NASDAQ 100 are almost all growth stocks and mega caps. So when it gets hit hard. Or the S&P has 503 stocks that are spread out, and there's some value, and there's not as many growth stocks in there, even though the growth stocks that are in the NASDAQ 100 are also in the S&P 500. But when this is going down, that just means the NASDAQ 100 is underperforming. But longer term, we still see the blue line above the red line. So we'll continue to watch this. Here's the S&P 100, which are the biggest stocks in the S&P 500, and they are underperforming now as we've seen more weakness in the S&P 100. They're both doing okay. It just shows here that the S&P 100 is now underperforming the rest of the S&P 500. The NASDAQ and S&P 500 shows how the NASDAQ, which is really heavy with tech stocks, or the S&P 500 has other diversification in it. It has been pulling back, but longer term, the NASDAQ is still outperforming. The NASDAQ 100 continues to underperform the NASDAQ itself, as we've seen some weakness in the mega caps. And the mega caps here have really fallen back down to the 200-day moving average when we compare it to the equal weight S&P 500. But we're bouncing up off of this. So we'll see if things are starting to shift back and favor more of the mega cap stocks. There's small caps, which were really starting to bounce up when compared to the S&P 500. Well, this past week, they're starting to come back down. Longer term, they continue to underperform. This is another chart. This shows the ratio in red, how it has been going down, saw a bit of a bounce, and now it's starting to decline. The blue part of the chart here is the S&P 500 itself. We look at the biggest software companies, pretty much chopping sideways right now, but still in an uptrend. And we're seeing the same thing on the weekly chart here. The mega caps did pull down and came underneath their 50-day moving average, but they're still in a longer-term uptrend. The robotics and AI ETF saw some weakness, fell below the rainbow, but is starting to bounce back up. And it had been trying to outperform the tech sector lately because a lot of these robotics and AIs, they're small caps. And so this was starting to come back up here and showing some improvement and is actually looking a little better than it had been. The Dow Jones Composite Average takes the Dow, the transports, and the utilities and puts them together. We're still above the 50-day moving average when we take all three, and this is in a longer-term uptrend. Then we compare the S&P 500 with 1 to 3 year bonds. We have been coming down as stocks were under pressure and bonds were bouncing up. We're showing a little bit of an improvement here, but we're still inside the rainbow. We also look at the S&P 1500, a broad measure market, and compare it with short-term bonds, also in the middle of the rainbow. Another broad market measure went a little further down compared with further out bonds, but starting to bounce back up later in the week. And the biggest ETF that I can find anyway is the total US stock ETF with 2,651 stocks. We fell under the 50-day moving average and we're right in between the two. But this is showing a bit of a bounce in Thursday and Friday's session. Low volatility stocks continue to perform quite well. They are in an uptrend, and these are more defensive as a general rule when you look and doing quite well when you look at them alone. But when you compare them with the S&P, even though they bounced up recently, longer term since the beginning of 2023, they have been really underperforming as the market has been less volatile and getting into more growth stocks. And the tech sector compared to 3 to 7 year bonds, we fell below the rainbow, but now starting to come back up. And then we look at the advanced decline line studies. I do show this in the daily videos, and this has actually been more encouraging. Even with the big down day on Monday, the advanced decline lines are still holding up. When we look at the NYSE common stock, the S&P, we dropped below the moving average with the mid caps, but then we've been able to get back above it. And the small caps are above the moving average too. So that's what I use as kind of a definition here. When we're above the moving average, that's more positive. When we drop below it, that's more negative. We look at traditional Dow theory, which you have in the top, and then the transports, which really have been lagging behind and pretty much chopping sideways. It's the utilities that have been giving the Dow Jones Composite more strength. Now, in traditional Dow theory, they don't include the utilities. I do. I have all three of these here to match up with the composite. And then we do a ratio between the transports and the S&P. They were starting to show some improvement, but now are pulling back. And over the longer term, we continue to see where the transports are underperforming the S&P. We do another ratio between the Dow and the S&P. When this is going up, that means the Dow is outperforming. Well, we've been chopping sideways over the last few months, so neither one is really outperforming the other currently. Here are the transports, which really just continue to chop sideways, and they pretty much have been range bound in 2024. And we look at a ratio between the S&P and the transports, they still are having a fairly high correlated relationship. So if the S&P is going up or down, the transports are usually going up or down at the same time. And then here's a new idea behind Dow theory. Instead of using the Dow, we use the S&P. Instead of using the transports, we use the NASDAQ. And we've been showing some weakness here, but bouncing back later in the week. This breaks it down even further using an equal weight S&P 500 and then an equal weight QQQ, which is the NASDAQ 100. And we can see here where we did see some more weakness. And people love the NASDAQ 100 when it's going up, but when it's under pressure, it tends to go down faster than the S&P as well. Here's the FANG index. This was one area of support. We came all the way down to the 200-day moving average on Monday when we saw the big decline. And we've been able to bounce up off of that. And this is Facebook, Apple, Amazon, Netflix, Google, Nvidia's in there, and some of the magnificent mega cap stocks that everybody seems to love when they go up and hate when they're going down. And this is, I tried to draw some trend lines in here. They're a little bit liberal. I just tried to pick out areas that may be providing some kind of support. We had fallen through this trend line, but then we were able to get back above it. The Wilshire 5000, which is another broad market index, we're below the 50, but still above the 200-day moving average. ARC, which it's just not doing all that well, and it's in a downtrend now. And we look at all world stocks taking out US stocks where they had been under some pressure, came down and actually fell below the 200-day moving average, but we're able to get back above that. And we do a ratio between US stocks and the rest of the world, and we're getting back up to the 50-day moving average with this ratio. And here's a monthly chart looking at the S&P and doing a ratio with global stocks in Europe, Australia, Asia, and the Far East. Still holding up fairly well, and we still show the momentum looking positive. Again, this is a monthly chart, so it takes longer for this to adjust. Looking at bonds, we are going up based on price with the total bond ETF. We're still in a downtrend, even though we're not quite there yet to cross the blue line with the red line. It's probably hard to see, but world bonds have been really showing some improvement lately as well. And we're actually seeing some more weakness with the monthly chart of the stock to bond ratio where it's really coming down, but we haven't crossed below the moving average at least yet. And here's another daily chart showing how bonds are underperforming stocks. Even though they bounced back up when we had the down day, they're starting to come back down a little bit over the last couple of days this past week. These are junk bonds. They got hit too, as folks are trying to figure out, is it time to get out of junk bonds and get into more conservative bonds? They came all the way down to their 50-day moving average, but have been able to bounce up since then. And this is the ratio where we look at riskier bonds, junk bonds, with more conservative or government bonds, where we were really coming down. Now, what folks do is they get into the junk bonds because they want the yield and they're willing to assume that risk. But when it looks like interest rates have topped out because we may be experiencing economic weakness, then they start getting out of the junk bonds and getting into government bonds, which are very safe. And that's when we see this ratio really going down. Well, as some of these fears, especially when the jobless claims came out on Thursday, and they came out showing that, okay, things aren't all that bad after all. Maybe we don't need to freak out about the economy. Now we're seeing this ratio starting to go back up, but we're still underneath the rainbow. And these are corporate bonds, which continue to perform quite well, but still have a long ways to go to get back to their highs set back in 2020. And we look at a correlation between stocks and bonds, and they're having a tendency to go in opposite directions. Bonds have been doing quite well. They're going up based on price. That's pushing interest rates down, but stocks have been going down lately too. And we look at the corporate bond index, which is continuing to be in an uptrend. And here are some Fibonacci studies, but we're far away from these lines, so we're not really getting any insight from this chart. Here's a longer term chart where we have been seeing lower rates for over 40 years. And now, even with the decline, we're getting into a higher interest rate environment. And that would be the actual norm. What we've seen over the last 40 years is not normal. And so as the market tries to figure out, are we going to go up for higher interest rates, or are we going to drop back down into what we had been seeing before? And then here's the 30-year yield with some fib retracement levels on here, but not really close to any of these lines. We look at the S&P 500 or stocks compared with the 10-year yield, showing how the S&P 500 has been outperforming. And then this is looking at bonds compared to stocks. When this is going down, that's more positive for stocks. Well, as we were running into trouble, this ratio really started to go back up, but later in the week, it started to come back down. We look at junk bonds, which also got hit earlier in the week, came down to their 50-day moving average, but have been able to bounce up off of that. And we look at a ratio between junk bonds and more conservative bonds. When this really falls off, that means that the junk bonds are starting to underperform, but now they're starting to pick back up a bit here. Here is the price of the 7 to 10-year bond ETF, which had really been going up. That was pushing interest rates down. Well, lately it's been falling back. Here's a daily chart of yields as they show a real decline over the last few months, but then they started to spike up as the market was freaking out. Here's a weekly chart looking at US, UK, German rates down here, and then these are Japanese rates. And this is when the folks were putting on all these carry trades because we're right around zero. And there were some points when Japanese rates were actually negative, like they were in Germany back in 2019 and 2020, even into 2021. And so it's like, okay, I'll borrow money from you, and then you'll pay me additional interest for borrowing that money. I mean, that's kind of how it's playing out. And well, with Japanese rates starting to go back up, that was really threatening all of the things that were built when the Japanese rates were down around zero. And that caused this whole avalanche through the financial system. All right, then we look at the volatility of bonds, which they really spiked up and are starting to come down. This is stocks. This is the MOVE index on top, which measures the volatility of bonds. The VIX measures the volatility of stocks. And there's a pretty high correlation between the two, not based on price. It just shows that both stocks and bonds, even though they're coming down, are quite volatile right now and going in the same direction as far as volatility. Here's a monthly chart of the 30-year where we did come back above the moving average. We had been below this moving average for years. And this is a little bit of a concern as interest rates have been going back, or price has been going back up and interest rates are coming down. And we do a ratio on the bottom between bonds and commodities where, again, this is a monthly chart, so it takes a while. Bonds based on price are still outperforming commodities. Then we look at the different sectors. Here's the materials sector, which is underneath its 50-day moving average currently and continues to underperform the S&P. It was bouncing back up as there were possibly feeling some love for the small caps. Well, that got threatened over the past week. And here's communication. This has been one of the stronger areas in 2024. We were able to get back above the 50-day moving average. And we look at the relative strength and momentum. They are quite positive right now. And they are going sideways when we compare it to the S&P because communication has been doing well, and it's been one of the stronger areas for the S&P 500, which has also been doing well. So we're not really seeing any outperformance right now. Look at energy, which came down and actually broke below its 200-day moving average, was able to bounce back above it, but it's still below its 50-day moving average. And when you compare it to the S&P, it's still continuing to underperform. Financials, this has been a stronger area, and this is more positive for the economy. We were able to get back above the 50-day moving average, and they're performing okay. We're going pretty much sideways here, even though we're in a downtrend with this ratio. Industrials were able to get back above their 50-day moving average, and they had been really underperforming the S&P, showing a bit of a bounce as we were seeing that the economy may be shifting to a point where interest rates get lowered to try to stimulate the economy. Well, we'll see how this plays out going forward. The tech sector, which has seen a lot of weakness lately, came all the way down and actually dropped below its 200-day moving average, has since then been able to get back above it, and it's still in a longer-term uptrend. And the tech sector to the S&P, this had really been outperforming. But as we've been under weakness in July and into early August, the tech sector has been underperforming. And the staples sector, this is more defensive. And we keep an eye on this when we look at it all by itself. And it's in a really solid uptrend. And this is what the market likes to get into when it becomes more defensive, meaning that we could be facing some declines. But when you do a ratio, even though it bounced back up lately, it's still in a longer term downtrend when we compare it to the S&P. Real estate, which also likes interest rates going down, they can sell more houses and get more mortgages. This has been looking pretty solid lately, and it's been performing well, but it's still in a longer-term downtrend when we compare it to the S&P. Utilities, this has been a stronger area too, and as I've been pointing out, there's a couple of different ways to look at this. One is that it's more defensive, and folks get into this when they're worried about the market declining. Another way you can look at this is that there's a lot of increase in utilities because of AI, because of Bitcoin mining, because of EVs, and all those kinds of things that are happening. And that could be really helping this sector to go up. So we have to keep an open mind whether this is a growth type area or more of a defensive area. But typically, it's been a defensive area historically. And we're starting to show where it's been coming back and actually outperforming the S&P 500. And then this is a ratio that we follow. When this is going up, that means the S&P is outperforming. When this is going down, that means the utilities are outperforming. And here's healthcare, another defensive area. It's still holding up quite well and above its 50-day moving average. But still, longer term, it's been underperforming the S&P, even though since July, it's been bouncing up. Look at discretionary, the thing that makes life fun. It got hit pretty hard. In fact, it's still underneath its 200-day moving average with this sector, and it continues to underperform when we compare it to the S&P. And Tesla is part of the discretionary here. We look at growth versus bonds, and it just shows that growth stocks have really been outperforming, but we've been seeing some weakness. However, we were able to get back above the 200-day moving average. And here's energy compared to tech. When this is going down, that means energy is underperforming. And this ratio had been going up, even though we're in a longer term downtrend, but it's dealing with its 200-day moving average with this ratio. And it's not, well, you could say we're seeing a little bit of strength in energy. It's mostly weakness in tech that has been driving this ratio back up. Semiconductors, one of the darling areas of tech, has been in a solid uptrend. It's still in an uptrend, but it really got hammered lately. Actually fell down below its 200-day moving average, but since then has been able to come back up above the 200-day moving average. And then we've been watching a ratio between small caps and the tech sector. When this is going down, that means the tech sector is outperforming. Well, we were starting to see a reversal there, but since then it's been pulling back. And here's the tech sector to the 10-year yield, showing how tech stocks are still outperforming the rise or fall in interest rates. Here's an inverse showing how interest rates have been underperforming the tech sector, even though the tech sector has been under some weakness. Discretionary to staples shows that discretionary is really underperforming staples. Here's an inverse showing how staples are outperforming discretionary. And gold to S&P ratio still really choppy right now. Now, the gold folks, they would say, oh, good gold, it's the greatest thing ever. Well, when you compare it to what the S&P's been doing, it really isn't outperforming by all that much. And it's been very volatile with this ratio. When we look at gold versus the dollar, we have been seeing some weakness in the dollar, and we've been pretty much sideways with gold. So this ratio has been going up. And this is an area, if you want to have a pretty good proxy for what's going on with the US economy, keep an eye on this. It's BKLN. These are high leverage loans. These are very risky loans. They're very leveraged loans. And they've been doing really well since the beginning of 2023 in a solid uptrend, barely coming down and hitting their 50-day moving average. Well, when everything freaked out on Monday, this really dropped. But now we're back above the 50-day moving average. So you might want to keep an eye on this. And I look at this every day and I just report on it when something happens. I usually only cover it in this video. But this is more positive, showing that things are looking a little bit better right now for the US economy. Look at all stocks, both US and internationally, we are below the 50-day moving average, but still above the 200, and we're still in an uptrend. The NYSE composite did fall down underneath the 50-day moving average, has since been able to get back above it. Emerging markets also really got hit, but still in an uptrend. And here's the Japanese Nikkei, where it just fell off a cliff. It fell, 12% on Monday, gained 10% on Tuesday, and then gained another 3%, I believe, on Wednesday. So it pretty much recaptured everything that was lost on Monday. But it's well off of its highs right now. Microcaps, also still in an uptrend, but they got hit with everything else, came back down to their 200-day moving average, and have been bouncing, at least for now. Bitcoin also got hit. It actually dropped under 50,000 there for a while. And we're potentially seeing a death cross here with the longer term trend, but we've been able to get back up into the 60s, at least over the weekend. And then we look at a study between the S&P and the Home Builders ETF. And what I really focus on is the correlation down here, and they're not diverging from each other right now. So we're not getting any real insight here. Internationally, this is a weekly chart. It's longer term. It uses a longer term oscillator. When we look at China, we're in a downtrend. Emerging markets, Europe, Japan, and the US. Globally, we are in downtrends right now. Then this is a chart going back to the beginning of 2024, where we have gold in the lead right now, followed by oil, and then stocks, and then the dollar. And a week ago, bonds actually turned positive based on price, but since pulling back are now negative year to date. We'll look at some correlations where we see that the dollar and the S&P are tending to go in the same direction, whether it's up or down. And the S&P to oil correlation also in the same direction. Now, if something happens in the Middle East and oil goes up for geopolitical reasons, we're going to see this relationship really drop, where stocks may go down and oil is going up. Right now, it's not really showing all that much of an impact. And the S&P to the 10-year yield also tending to go in the same directions as the market's trying to recalibrate here. And the tech sector to the 10-year yield also going in the same direction. And the S&P to 2-year yield also in the same direction currently. And then we have some long-term looks here. This is a monthly chart of the NYSE. We're still above an advancing moving average. So longer term, we're still positive. And the Kopit curve, which is a momentum oscillator, continues to go up. And then we have a daily chart here where we're starting to roll over a bit with the PPO. And we're seeing that on the daily charts that I do in the daily videos. But we're still above the moving average here longer term. And I'm sorry, this is a monthly chart of the S&P. So going back to this is actually a little bit more negative now that we're looking at the monthly chart. Based on price, we're holding up, but momentum, we seem to be showing some weakness. And then we look at a daily chart here of the NYSE record high percent index. It's continuing to go up. So that's looking back more positive. And we have the S&P on top. And then we look at a ratio between stocks and commodities, showing how stocks continue to outperform. And then we look at stocks on a monthly basis, comparing it to other global stocks, showing how US stocks are outperforming, and we're still flat with the KST, a momentum oscillator. Then at the very end, I list all those things that are positive, and my definition for this video is when the 50-day moving average is above the 200-day moving average, and we have a pretty long list. When you look at growth and value all by themselves, copper, although it's getting ready to cross over, it's showing a lot of weakness. It's still in a longer-term uptrend. The British pound to the US dollar, gold, silver, the dollar index itself, although it's getting ready to cross on the weekly chart. The CRB index, the big software companies, the mega caps, the FANG index, low volatility stocks when you look at them by themselves, staples, the Dow Jones Composite Average, the bonds based on price, everything except we're showing an improvement with the world bonds, but they're not quite crossing over positive yet. The tech sector and semiconductors, the high leverage loans, the Dow, the NYSE Composite, as well as the Wilshire, a couple of broad market measures, the NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps, all stocks, emerging markets, and Bitcoin. These are all in uptrends, even though some of them are in danger, even though some of them got hit pretty hard this past week. And there's some justified criticism for using a 50 moving average crossover with a 200 because there's quite a bit of lag there. But it's just what I defined years ago and have stuck with it. When we look at the negative side, this is when the 50-period simple moving average is below the 200. We have barely the euro, and I keep forgetting to change that. It should be the USD there. And then the Japanese yen to the dollar, even though it has been bouncing back up lately, ARK is in a downtrend, and then the Pring World Bond Index, which could be getting ready to cross over positive. So that might be changing fairly soon. Thank you. I hope you found this helpful. I hope you have a wonderful weekend, and I will talk to you in the next video.